The A.J. Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, A.J., whose primary mission in life is to help you become a better investor.
All right, welcome back to the A.J. Brown Show. Good morning, A.J. Broadcasting from the lovely new studio. It's starting to come together.
Starting to come together. We're putting a couple of things together. Better connections. You should see me without jitter today.
Yeah, and that's moving on up. But it is a holiday week, right? So you're probably spending some time with the family. But let's get into the gist of it, right? Today is December 22nd. I keep hearing this Christmas rally jargon everywhere, here and there. And last week, we broke through that big 4,600 level. And then this week, we kind of pulled back. And I know that's in your notes. We'll talk about that later. But we just had some inflation news. Still a lot going on for a holiday week. Where do you want to begin? What is capturing your attention off the bat today?
I mean, why don't we start with all the economic news this week, especially today's economic news? Because today's economic news, I'm actually going to pull out my old magic marker here because there's a lot going on. While that's loading up, we had housing starts and permits. So, the housing industry has been one of those things that, a lot of folks are looking at because for all too long there wasn't enough building for the amount of people here in the States. And so it's become kind of this crunch where, rents are quite expensive. There's this big push to right size the amount of housing for the amount of people, right? And so everybody's looking at housing starts. They're looking at existing home sales. They're looking at new home sales. And that was all this week. So coming over here to existing house starts and permits, one thing you can see here is that the amount of starts for the month of November was really a lot higher than expected, right? By about 200,000 more homes were started. That means people actually started construction on them. Now, permits came in as expected for November, but just to see that there's this big push to build new housing is quite interesting. And then we come on back and we take a look at Wednesday. Well, first of all, Wednesday we had consumer confidence, right? And this is an interesting economic measure, right? Anything at 100 or above is positive, and anything at below 100 is starting to be negative. And so you could see they were kind of expecting a little bit of positive expectations on the holiday and things. Look at where it came in. This is again November, not even December. Oh, wait a second. I'm sorry. This was for December. But still, this is showing that consumers are strong and out there and spending their money. So that's an
Have you ever
interesting.
seen it higher than that? Because that seems pretty high.
That's kind of the edge of the scale. I mean, I've seen it go up to as much as 115. I don't know how that scale is graduated. Like, is it kind of like an exponential scale or not? But yeah, that's very strong consumer confidence. Then we take a look at existing home sales that came up. A little bit stronger than expected, right in line, showing that there was a little bit of growth in November versus kind of the pullback on higher interest rates that occurred for the year. So it shows that the housing market isn't dead, which is kind of a good thing. It's all positive news, Sip. Let me just hit a couple of other highlights really quick. GDP. Now, this is the final numbers for quarter three. Next month, we're going to start looking at quarter four. But it was revised slightly down, but 5%, roughly 5% GDP growth under this, strong inflation interest rate market. I mean, that's unheard of. It's like a Goldilocks situation. And then you come to today, well, gosh, durable goods. This is like things that are around for 5, 10, even more years. Um, we really expected, looking in October at the drop of durable goods, look at, we expected 2.4% increase. We got a 5.4% increase. When you factor out cars, I mean, it's still showing that, hey, things have not stopped, and everybody's worried about, did the Fed go too far? I mean, this is showing strong data despite all of these interest rates. And then you take a look at this all important, and this was just released a couple of hours ago. This is the personal income and outlays. I look specifically at this number right here. This number right here at 0.1%. That, if you multiply that by 12 months, that's the month over month number. That comes to what? 1.2%. So if you look at that and you look at this other one, which is so that's kind of, extrapolating forward. This would be going backwards over the last 12 months. It's at 3.2. So if you go somewhere between 1.2 and 3.2, I mean, you're just about where the Fed wants you to be at 2. And so all of this rhetoric about the Fed, stopping with their rate hikes and possibly thinking about pulling back in 2024 seems to be making a lot of sense, right? And I guess the last data point as far as economic news is concerned is just a few minutes ago, we got the new home sales. And, they were a little bit tepid, but with new home starts being where they were in November, I would expect that new home sales in 2024 are going to kind of level out. I think this is like the perfect Goldilocks situation. And, it means that we're still strong, and at the same time, we're controlling our inflation, and employment is doing well. I mean, the Fed must be pretty happy right now.
Would this lead them to stay at the current rates, or would they come out and say, "Hey, we like where inflation is, and we want to just lower rates quarter basis point because things may start to heat up again," or something
Right.
along those lines?
So the Fed has the Fed has had a lot of challenges, and I think so far they're on their game. They've, despite all the negativity around what the Fed was doing for the last couple of years, I think that so far things are turning out well, but there is a lot of work ahead. And what I mean by that is, remember, on this show, we keep talking about their quantitative easing that they've been using for a while, and they really used a lot to get us through the pandemic. And they really need to, and their mandate is to pull this quantitative. So it's converted. Quantitative easing is whenever this graph is going up. And so you notice that for the last year, the graph has been going down. That's called quantitative tightening. They have a lot more. In fact, their target is to bring it down to this level, right? So at the rate they're going, it's going to take about 2, 3, 4, even 5 more years, depending on if they have any more of these little bubbles. This was the burp that they had to deal with when regional banks started to fail. So this acts as a brake on the economy. Quantitative tightening acts to slow down the economy. So if they're going to continue this effort and it's going to act as like a tax or slowing down the economy, they're going to have to balance that out with their interest rates. So if you take a look at what investors think that, well, this number has actually been going up. So investors last week were thinking that the Fed would come to the end of January and pretty much remain unchanged with interest rates. But ever so slowly, this bias of maybe dropping a quarter point in January, it's still not the majority, but this has been growing, and that's worth taking note. But definitely, looking at the March 20 Fed meeting, they show a quarter rate point drop. And then the May meeting, they show another quarter point rate drop. And the Fed has said, perhaps 3 or 4, and I think that's the case. And I think it's going to be fun, just from an outside perspective from this show, to watch how they balance this, because really they don't know how this quantitative as you can see in the past, Sip, they haven't done much quantitative tightening. They've only done quantitative easing. So they really don't know when they do this quantitative tightening, when they're actually shredding the cash that they had injected into the markets. They don't know what effect that's going to have, whether it's going to have a drastic effect or a mild effect. So it's going to be interesting as they do this tactic that they just have to do. They have to get the IOUs off their bank books down, because it just doesn't make sense as a functioning government in the long term to have that many IOUs. So they have to get that number down, but they don't know what effect that's going to have on the economy. So they're going to have to, be very careful with these interest rates. They're going to have to bias lowering them faster than raising them if they want to keep the economy on track.
Yeah, and
So
it's like if you look at this chart and then you compare it to the S&P, it's almost like we've created value by printing money, and as we start to depreciate the money or deprecate the money, will the stock market follow suit?
I mean, that's the big question. And that's the big question on my mind. In other words, people are looking, of course, folks don't like to look very long term out, which I understand, right? But the scoop is right now we're in a very Goldilocks situation, and we're seeing what we saw about 3 or 4 years ago, where people are being enticed into the markets, not only because it's so much easier. You and I were talking before we even got started with the show about how you, with your Charles Schwab account, all of a sudden have access to Thinkorswim. Everybody is starting to get access to be able to do trading on the market. So it's easier than ever. You don't have to register with a broker and call them and have them trying to convince you not to buy. Now you just go and you place your trades and you're involved. So we're seeing a whole bunch of money coming in on this Goldilocks situation, which typically would not have been in the markets in the past. So it's kind of like newbie money, or a neophyte money, however you want to say it. But I almost wonder, because Wednesday, I don't know if you guys paid attention, but Wednesday we saw a very fast sell-off from the market movers. Those are the people who have the most money in the markets, the pension fund managers, the hedge fund managers, the mutual fund managers. They did some selling on Wednesday, and that was something that I paid close attention to. They're ready to sell at a moment's notice. So you got to be careful about getting in the market, especially with all this overhead resistance at all-time highs at 4,800. Despite it being a Goldilocks situation, there's a lot of work ahead of us in order to keep things on track and not have it spill into a negative situation. And so I'm still, and I know that I'm playing the negative Nelly here, but I still believe that there's going to be a pullback. I don't think we're going to get above 4,800. There's just too much overhead resistance. I feel like we're going to get a pullback, and the key data point, Sip, is figuring out where we actually reverse from. So what is our highest close? And so far, our highest close is this one right here, December 19th. We'll see what happens today, but right now, December 19th is our highest close. That was Tuesday's close. So paying attention to where the highest close is before it's down, and then even more importantly, where lowest close when we start to reverse back up. Those two data points will actually forecast for us what's going to happen for 2024. So I'm really paying attention to that.
And we've been referencing that 4,600 mark. Now it sounds like we're referencing this 4,800 mark. And so I imagine that we'll be in the range for quite some time, which bodes well for some of your options trading strategies, right? Which is one of the reasons we have the show, and one of the reasons that we'll go over some examples, because that you're if there is that pullback, which most likely there will be at some point, can you as an investor position yourself to take advantage of that? And I think the answer is yeah, right?
Yeah, no brainer. No brainer. That's what options allow us to do, right? Options don't, when you're dealing with just stocks or even commodities, or even, if you're trading currencies, you're trading with either buying and hoping that it appreciates, that's called going long, or you're talking about, selling, basically there's this process where you can borrow from your broker, sell at a high price, and then buy back at a low price. That's when you're going short. So there's only those two, and they're called directional strategies. But when you start to incorporate derivatives like options and futures, and I'm a fan of equities and options. Incorporate options. I mean, options allow us to profit when the market goes up and down, but also when it's going sideways, because there's a time component to options. And then also because options are used as hedges, we can profit on whether there's a use, whether there's confidence in the market or whether there's fear in the market. Because when there's fear in the market, option prices appreciate. When there's confidence in the market, options depreciate. And so just knowing what's happening, paying attention to what's happening, we can go into our tool chest, and instead of just having two tools, we have up to 27 different tools. Just find the right tool and we can profit from any situation. That's why I love options, Seb.
Yeah, and we're going to go through a few examples later in the show, but because we don't necessarily have a topic of the day, I do want to ask two more questions, and that is, as we're seeing all these markets and industries increase, I don't think that's the case with energy, right? It seems as if oil has been moving in the opposite direction. And then the second is bonds, in the sense that the rate has stayed the same, but bonds are pulling back. And what are your thoughts on both of those markets right now?
Well, let's first start with oil, right? So oil's interesting, and of course, it may get a bump up because of, I think there's some skirmishes in the Red Sea. So oil tankers have to take a different, longer route, and all of this good stuff. But then there's also overproduction, and the fact that the U.S. is producing, more oil than that they've ever produced before, and they're a major, um, you know, they're definitely disrupting what OPEC had as a monopoly back then. In fact, I just heard that one of the OPEC participants, Angola, was thinking of pulling out, or has issued formal requests to pull out of OPEC, which is an interesting little tidbit there. So perhaps, the writing is on the wall with the whole energy cartel around fossil fuels. So with that said, oil it's been pretty stable at about $70-$75 a barrel. That's actually an okay price for the energy. I don't think that means that energy companies are going to invest a lot into pipelines or increasing infrastructure. It's kind of a steady state price. So, and that's a good price for us at the pumps. I think that everybody's gotten a little bit of relief at the gas pumps, and there should be a little bit more relief, especially once we get through the winter and the summer starts to come, and people aren't using heating oil and things like that to heat their home. So, I'm not such a negative Nelly on oil. With futures, of course, you can trade commodities like oil in all different directions. So if that's your deal, but as far as the energy stocks that depend on the oil prices, they're going sideways and choppy, and that's just what us option traders who like to sell premium love. So this is bringing up a whole new sector of candidates for us to trade premium on. Now,
And then
you also mentioned
bonds,
bonds.
right?
So bonds, it's interesting, right? The Fed controls the overnight borrowing rate. They don't control the bond market, right? The bond market is set by buyers and sellers, right? And so the 10-year Treasury bond is just under 4% right now. It was at a high once, not that long ago, but it's been pulling back. But 4%, I mean, that's not bad. And for so long, our 10-year Treasury bond was close to zero. And so to have it up at 4 is not a bad thing. It means that people's savings accounts are going to make money. It means that they can buy bonds. It actually is a return to a balance that I haven't seen since like in the early 2000s, late 90s. This was a balance that had been all around. Uh, you know, a lot of people have the amnesia, but that balance kept investors and kept retail. It was a really good place for us to be. So I'm not actually offended by the bonds being at 4%. I'd like to see them stay maybe between 2 and 4%. So we'll see what happens in the future, but we could trade it any way we want, Seb.
Awesome. All right. So let's go ahead and give everyone an opportunity. If you're enjoying some of the commentary that AJ's providing, stick around because we're going to go into a few examples. We've got AJ's pick of the week. We've got our speed round, and he's really going to get into these one or a few of these 27 strategies on how to take advantage of, if there's a pullback, if not, in some specific names. And if this is something that you're interested in learning more about, jump into AJ's free daily workshop. I went ahead and threw the link into the chat. So if that's something that you haven't checked out yet, head on over there, sign up, check it out. We're going to take a bit of a break. And now that I think of it, AJ, I know we don't have a topic of the day, but I do want to show you something that I think our viewers would appreciate. So
Absolutely.
stick around, and we got a nice little surprise for you.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. So, as you know, or maybe, well, but I don't know if all the viewers know, I live in Los Angeles, and part of the big issue in Los Angeles and maybe some of the other cities is traffic. I mean, I think part of it here is that there's just too many people and there's not enough streets. And so in my mind, I'm always like, well, what does the future of transportation look like for my generation and the younger generation? And I came across a video today and I was like, oh, this is what it looks like. Here it is. Look at this guy.
Look at that thing.
I mean, look at this thing. Hold on. Is he going to get into it? Yeah, there it is. It's flying. Now, can you imagine a world where instead of hopping in your car, someone's walking outside and they're hopping in their little drone helicopter and they're taking off and there's a landing pad somewhere? Because, I mean, I think this is what it looks like if we're ever going to get there.
That's cool.
All right. And so this is what it looks like.
That's very cool. Is that a company? Is that a company?
Well, if it is, I mean, I'm sure it is, but the Hexa lift. But I mean, this is kind of like that Jetson stuff that we saw, like with what people imagined the future would look like. And I don't know if anyone that's flown a drone, they're actually pretty reliable. Like, you can maneuver. The only thing I would think about here is if one of the wings goes down and you got to hop out, like you got to have like a little parachute or something, like a inflatable.
Those drones are quite interesting, right? They have object they can make sure that they don't hit trees and they can make sure that they don't hit power lines all by themselves. Somebody showed me a drone just the other day where they were running through a park and they could set the drone up and the drone would follow them and take pictures of them from behind, and then as soon as they would turn around, the drone would be able to keep the camera on them and follow behind and create all this. And that's all like automatically driven. So you're just scaling up. It's not like you're creating any new technology. It's the same software. It's just that you're scaling it up to a bigger unit. But
Yeah.
you know,
And
I think
putting
it's
a, 200-pound person in there, right? Whatever the weight
yeah.
capacity is.
I
Um,
mean,
it's funny that you say that because I don't know if you've ever seen those drones where they like fly through fly through a building, right?
yeah,
I had a client make one of those recently, and I was very impressed, and I was interested, and it really did a good job. So anybody that does that stuff, kudos, like that. It's amazing. I love seeing it. And I think in a couple years, like we could see some flying drone concepts. Like
yeah.
I wouldn't mind getting a license of some sort to test it out. Anyways, I thought that was interesting. All right. So everyone's sitting, we got a nice handful of viewers here today. Everyone's interested in what you're looking at, AJ. So let's go ahead and dig into your pick of the week for the week. And that's gonna be ticker symbol
Coal.
KSS, Coles. That's right.
So Coles has always been one of my faves, and I'm going to zoom out a little bit because Coles is sideways, but it's a much slower up and down, right? Slower up and down chop. So what you have to do when you have slower, when I say slower, I mean that the bottom reversal to the top reversal is taking a longer amount of time, but it is going through a nice dollar figure. So you can actually profit off of that additional dollar figure. And it's just a slower moving, would actually is quite useful for some of us traders that aren't able to hit the signal right at the moment that we get it. So what you have to do when when you've got something that moves slower is you have to use a slower signaling, right? And so one of the things that this is using our free indicator SIP. I'm going to pull away the indicator that I was using for analyzing the broad market. And instead, I'm going to pull in an indicator that I set up to look at coals. Now, this is the same indicator, the same free indicator. It's just got different settings. Let me review those settings. This is just the traditional MACD. It's not the fast MACD because this is moving slower. So this is the normal MACD, but I'm calculating it based on volume weighted average price versus close. So the normal MACD is a 12, 26, and 9. And so if you set up your indicator as a MACD indicator with VWAP as the price and 12, 26, 9, all exponentials, don't put on the 1 bar reversal filter. And I think that what you're going to find is a nice end of day indicator for trading coals. Now you can definitely modify that further if you think that you can get it better. And again, this is an end of day indicator, so you'll need subsequent day trading follow through to actually place the trade. But when I analyzed this indicator, the normal MACD with end of day follow through, I got my signals. And so I am looking for a top to form here, a signal to come my way. It hasn't come yet, and so I'm waiting for that end of day signal followed by subsequent day follow through. But when I get that, there's a whole bunch of things I can do as an options trader. If I'm initially getting into a position, I need to set up an initial, what we call a covering position. I can either short some Kohl's stock if I have a margin account, or I could buy a deep in the money, far out in time put option. And the one that I'm recommending, at least right now, is the Kohl's August 2024 $40 put. That's the one that I think. And again, I got to wait till I get my signal. When I get my signal, I may change my opinion altogether. But right now, that Kohl's August 2024 $40 put looks like a nice substitute for shorting the stock. And that way I can use a cash account. So that's one thing I can do when I get that signal. If I'm in the position already and I've got some protective calls that are in, part of my trade, I could, when I get that signal, I could liquidate those calls for a profit. It's called rolling those calls out. So that's another thing I can do. And finally, if I had bought some calls or bought some substitute call options when it was at a low, when I get this signal, it would be a perfect time to sell some premium. And so it's writing the covered call. And right now, again, it might change, but right now I'm looking at the Coles January 19, $28 call. And at the same time, I would buy some protective puts. And I'm looking at the Coles April 17.5, or even I've been talking to some of my folks in my actual paid program about tightening up their trade zone. So I could see also doing the $20 protective put. So yeah, so many choices on Coles. Again, we're waiting for that end of day MACD signal SIP. But man, there's all these trades to be had on Coles, and it's one that if you miss it by a day or two, that's fine. You're going to be fine. You could place the trade and still be set up for profit. So I really am liking Coles going into the holiday season.
Yeah, and I imagine if Q1 they come out with some rhetoric in that they didn't hit their expectations, that could be some fuel that helps bring this in the right direction.
That's right.
For us.
That's
all right.
right.
That's Cole's ticker symbol KSS. Moving on into our speed round. I'm excited about this first one because it was all over the news on Wednesday, I believe. So this is Thad from Denver, Colorado, interested in FedEx, ticker symbol FDX. AJ, what the hell happened to FedEx this week?
Well, FedEx reported, so this is a perfect example, Thad, of a stock that's in the news and that people look at a lot, not just investors, but everybody looks at FedEx, right? They look at the transportation sector in general, but they look at FedEx, they look at UPS, because those are the companies that bring us all of our goods. We're in an economy now where a lot less people go to the store and a lot more people order stuff online, and FedEx and UPS are one of the biggest deliverers of all that stuff. So FedEx came and they said that they didn't do as well as they had expected. Now, you look at their earnings and they did pretty freaking well, but it was below what what investors expected. So investors kind of hit them on the head. Now, as far as trading this, that I think I see where you're going. I think you're thinking about, getting in at a low, and I think you might have something there. I see some support at 240. I would use, based on how FedEx is moving, I like that same indicator combination for a signal that I was just talking about for Coles. So again, that's just the normal MACD. I like throwing in its calculation on VWAP. So if you download my free indicator, you can do that. You can substitute the close price for the VWAP price. And I would wait for that bottom signal to be identified, and that would be an end of day signal. So make sure when you get your end of day signal that you then look for follow through on the subsequent trading days before actually placing the trades. That's your protection, is making sure that there's follow through on the day you're going to trade, so you don't get into any silly trades. You can see right here that we got this top signal, never got the follow through, and you can see that top signal was then erased before we ever got follow through, only to get us in at a better price. So don't dismiss the same day follow through. It needs to be there before you place the trade. But I could see that this would be a good opportunity to either, if you've got deep pockets, that buying FedEx stock, and if you could buy it in lots of 100, I know that means that, if it's at $240, you're looking at what, $24,000 for 100 shares. But if you've got deep pockets, that's definitely an idea. Another idea would be to buy a substitute option. You could probably get it for less than half the price, so $12,000 investment. Or Gosh, this looks like a really neat opportunity for a vertical spread. Now you can get vertical spreads really inexpensively. My only warning on vertical spreads is people underestimate the amount of risk. Pretty much when I put a vertical spread on, I expect 100% risk, meaning whatever I put into the trade could easily be lost, all of it. So size the vertical spread position based on how much of your portfolio you're willing to lose. So, for instance, I like to keep my trades down to around 2% of my portfolio. So, I wouldn't buy a position in this that was more than 2% of my portfolio. So, keep that in mind if you're going to use vertical spreads. One of the biggest errors in using vertical spreads, whether they be debit or credit spreads, is people use too large of position. They expose themselves to too much risk. They underestimate the amount of risk involved with a credit or debit vertical spread.
Wise advice. I do have a question because Wednesday's entire market pullback was kind of blamed by FedEx. Did they release earnings like in the middle of the day?
No, they their earnings. Let's see here. It came after market hours. But they started to the after market hours was the day before, right? So that was on Tuesday evening is when they released earnings. So
Mm,
all day Wednesday. But you got to remember that again, FedEx and UPS, they don't just represent themselves. They represent if they say that things were less, if there was less FedEx business than expected, people jump to the conclusion that everything's slowing down because FedEx is one of the main deliverers of products, right?
I think that's the main correlation. Yeah, definitely.
People pay attention to the transportation sector specifically, right? There's some ETFs that are like that as well. They pay attention to that because it really is a litmus test of the overall economy. If there's goods being bought and sold, transportation's up, right? Meaning, like freight transportation is up. If the economy's starting to slow and things aren't being bought and sold, freight, activity is down.
All right, FedEx. We'll keep an eye on it. Definitely on the more expensive side. Moving on to our next name. This is Bill in Irvine, California. Interested in your take on VF Corp, ticker symbol VFC.
Do you know this company,
Not
Sip?
familiar at all.
Oh, I bet you do. What? Check this out. VF Corp is a clothing brand, right? And if you are they a clothing manufacturer, and here are some of the brands. Let's
Oh, Timberland, North Face,
Yeah, Vans,
Supreme.
Dickies. One of my favorite brands is Dickies. JanSport, if you're outdoorsy. Eastpak, if you like backpacks. Um, a lot of newer brands out there like Smartwool. So yeah, VF is kind of an outdoorsy type brand that's more for the active folks out there. Um, um, so yeah, I just wanted to let people know if they had never heard of that company before, what VF company is. They're the umbrella company for all those more popular brands that we've seen out there. So let's take a look here at the chart. Um, okay, so I see what you're thinking about with VF Corp. I like the price range, by the way. Let's take a quick look at our option chain. So I'm going to switch on over here to our active options chains. I'm specifically going to look at my May options. They're trading every $2.50. Not as heavily traded, but not definitely something we can do here. But with it trading at $2.50 increments, what you'll notice is, it doesn't completely put limits on us, but this is where we would have to um, design our option strategy. So the beautiful part about option strategy is that we actually design where our trade reacts by the strike prices of the options. So because it's instead of every dollar, every $2.50, it does put a little bit of a limit on us. But I'm not concerned too much. My bigger concern about VF Corp is I'm going to come a little bit closer in. I'm wondering like where this thing is going to go next. I'm going to switch my indicator to my fast MACD. So I'm going to turn off my standard MACD indicator. Just turn it off like that. And I'm going to put on my fast MACD indicator. This one. The fast MACD, for those of you that aren't familiar, is 619 and 3. And again, I'm using my volume weighted average price as my calculator. This is a little bit more difficult to trade, Bill, but I see what you're thinking here. I almost feel like, this comes down to, do you want to have this stock in your portfolio, right? Because I could see somebody betting on this company, wanting, how we all have a little bit of stock that we just keep in our portfolio. It's shares of companies we think are going to do good in the long term. If that's your goal, what I would use is the cash secured, or sometimes it's called naked put strategy. In other words, if I come over here and look at the option chain and I come to the near term options, so that's the January 19, and I look at, for instance, this $18. So if I'm willing to pay $18 a share for the stock is currently trading at $18.91. So if I'm willing to pay $18 a share, I could, instead of just paying $18 a share, or biting the bullet and paying $18.91, I could sell this put. Currently I'd get 65 cents a share. And then sometime between now and January 19th, I'd either be exercised, which means I would then buy the stock for $18, or it may not go that way and I might just get to keep my 65 cents a share, and I'll do it again after January 19th. So I would do some creative ways of purchasing VFC into my portfolio, not necessarily just buying it outright. But that would be my play here, would be, if I want to put VFC into my portfolio for the long term, instead of buying it outright, let's sell some naked puts or some cash secured puts at the strike price we're willing to pay. Let's see what the 17 is. If I go for the 17, for the 17, I could still make 37.5 cents. And then I might not even get exercise. So I could just make free money every month, waiting to get exercised at whatever price I'm willing to pay for VFC. So I kind of like that as my go-to strategy, Sip.
The naked put, right?
The naked put, the cash secured put.
All right. Thank you for that, Bill. Appreciate the insight. Moving on to our third name in the speed round. This is Mary from Providence, Rhode Island. And I saw on the headlines today that this is one of the most heavily shorted stocks on the exchanges, and that's Carvana, ticker symbol CVNA.
I gotta say, if you guys remember, you can actually watch a replay of our show. And sometimes, you have to admit, when I marked this company as dead, along with Peloton, which I think Peloton is still dying, but Carvana came back, right? Carvana recreated themselves. Their share price, I'm just showing you a history here. I'm going to go back even further in time. You can see that Carvana was trading, when it first was out there, as high as $240 a share. And then it had dropped down almost to, $7 a share. It was almost going to cross that $5 threshold into being a penny stock. Over here, it was look, it closed at $5.04. It closed at 4. It was down in the penny stock era. And they took what remaining investment they had and they really used it wisely as a company. And I give them kudos. And they basically, you know, instead of just being a bunch of hype, they started to deliver on what they were doing. And look at this last earnings season. So if you take a look over here, they were losing, and the amount kept dropping. So they reinvested quite a lot into the company right here. You could see they really took a lot of that money that they had and restructured. And get this last result, they actually showed a big profit. They actually earned good money, $3.60 on a $20 to $40, $60 price tag. That is stellar. That is, that gives me pride in the whole market system. So with that said, let's talk about how to trade Carvana. So yeah, it is heavily shorted. I'm not going to lie. I'm just so impressed that they made $3.60 per share on a $25 share price. That's over 10%. So, but people still think that they haven't figured it out. I'm a little bit more optimistic, but it doesn't matter whether I am optimistic or not. Investors, we all know that how a company actually does versus whether investors buy or sell, it's not related, right? And so there is a lot of shorting. And so I would almost say, let's see if there is a top signal that forms. I haven't gotten it yet, but if a top signal forms, I wouldn't be adverse to you shorting some Carvana, either shorting it or buying some back month put options. Deep in the money, far out in time put options so that you could take advantage of a drop in price. And if it drops, significantly, you're set up well. Just play it as a directional trade. If it doesn't, then you could sell some put premium and turn it into an income generator. So, I think Carvana is going to be a company that sticks around for a while. I don't think it's going anywhere. I think they made some good decisions, but yeah, I get a feeling that they're extremely overbought right now, meaning the price is higher than it should be. And all that shorting news, I think it could take hold. And so if you pay attention to your signals, you could jump on that bandwagon and short it along with the rest of the folks.
Yeah, and we talked a couple of months back about just the auto industry and foreclosures in general, but
Repos, yeah.
or repos, right? And this is kind of the consumer fighting through that sluggishness, especially on the auto side. So, follow up question to the shorting. Would this be similar scenario to like the GameStop when there's a certain point where the shorts start to reverse and it slings the stock the other way?
Well, and so that was an interesting situation, right? So when the market movers kind of collude, and this is, there's a lot of experience in the markets. And so when you're a newbie, you have to realize that there's smarter people in there than you. And I like to tell my folks to just be humble, right? And so the smart money was shorting GameStop. They were shorting AMC. Those were the two companies. And everyday folks did something quite unusual. They got together on Reddit and they actually became a fund, for lack of a better term. They all agreed to buy into those shorts. And so, and by, it's a very interesting experiment on Tribal. thoughts, right? That they used Reddit to do that. But a lot of people decided to buy into those shorts, which, basically freaked out the big money who was betting against GameStop, betting against AMC, because all this retail money came in and it made their shorts not go the way they wanted to. And if you look, there's been some biographies on that whole thing, and you'll see that those big money traders, they had to buy to cover, and they lost some money. They're not used to losing money. They're used to taking the newbie traders and figuring out ways to get their money into their pockets, right? Get the newbie traders' monies into the big money pockets. And to have the reverse happen, they complained to the powers that be, the exchanges, and the exchanges actually, you know, put in rules that prevent the retail. It's quite an interesting topic. And yeah, so reversing those shorts. I've always been a fan of, figuring out what the big money is doing and jumping on their coattails. I think that's the more tried and true practice. But it is interesting that these folks just colluded on Reddit and created basically their own. They became market movers, and they totally outsmarted hedge fund traders. It's very humbling for the hedge fund traders.
Yeah, and I bring it up because I don't imagine those two examples are going to be the last time that happens. I mean, with the ability to collude and talk about positions and go against the big guy, I mean, it's
I mean,
more
the big
readily
guys,
accessible than ever.
the big guys really got upset about that. The big guys really complained, and they tried to put, and in some cases were successful at putting in rules into the exchanges that don't let that happen again. But people are very innovative, and they'll figure it out again. So yeah, I don't think that's going to be the last time. But boy, did the big guys just did not like that.
Yeah, and there's actually a few documentaries. I think they just released the feature film about GameStop.
I need to check those out. I've read a couple biographies, but I need to see some of those
There's a few
documentaries.
on Netflix. So that would be the first place I would go. They're not bad, and if you're into markets and trading and history, it's definitely going to be one of those that we look back at some point. So thank you, Mary, for Carvana. That's one we've covered a handful of times. AJ, I feel like the market's starting to just everyone's giving up for the day. They're hitting the roads. They're heading
Yeah,
out to their
volume is low today.
and I imagine Monday, even Tuesday will probably be a bit sluggish. Maybe even Wednesday, Thursday, Friday, because then we got the New Year again on Monday.
Yeah,
So we'll keep an
yeah.
eye and anything to look at heading into next year or next week.
Next week is going to be, so what we always say is that the week between the Christmas and the New Year's holiday is always an interesting week because not many people are trading. And so you'll see it in volume. The volumes will be low, but what you'll see is the price moving in unusual ways. And that's because if you think about it, the people who remain, who do you think would remain between Christmas and New Year's? Not anybody who has a family or who has a traditional life, but probably folks that are a little bit more extreme in their beliefs, extreme in their values, right? And they're the ones who are going to be trading next week versus everybody else who is more typical and is like, it's holiday time, it's winter time, it's hot cocoa time. I'm not going to be. So you've got these extreme people who are able to now move the markets because the balancing force of all the other investors who have more traditional beliefs are not present. So we typically see some extreme price action, and my suggestion to all the folks watching our show is don't buy into any extreme price action next week. Wait until level heads come back after the new year. Just if you're going to do any trading at all in the upcoming week, do little trades that, are fast trades that you make a couple of bucks here and there. But I wouldn't bank on any of the opinions that are voiced through investments next week.
Yeah, always an interesting time. As always, once again, we want to remind everyone that if you haven't checked out AJ's free daily workshop, the link is in the chat. Head on over there. You'll get access to all sorts of stuff. You'll get a couple follow-up reminders with some of the cool things that the team at Trading Trainer is up to. So head on over there. If you've enjoyed the broadcast, please hit that like, hit that follow, hit that subscribe button. We've seen a nice steady growth over the past couple of weeks. So we'd like to continue on that trajectory, and we appreciate everyone tuning in. As always, if you have questions, feel free to leave it in the comments. Feel free to send us a DM, a message. Someone on the team will get back to you. Otherwise, AJ, thank you for your time. Enjoy the holidays, everyone. Happy Hanukkah, Merry Christmas, Kwanzaa, and Diwali. I don't know. There's a few in there. Whatever it is, just take some time, reflect on the year, and we're going to be doing our best to get into 2024 and have some solid returns and concepts, and doing everything we can to continue to improve on the investing. AJ, any final words?
No, that was good.
Awesome. All right, everyone. We'll catch you guys next week, potentially the new year. Stay safe, everyone.
Take care, everybody. Bye-bye.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.